Hello once again to everyone who has joined. I think it's time for us to start. It's 2 p.m. exactly. And we're going to begin with a keynote speech presented by Adam Richard. Adam is the head of corporation development at Entoro, who has also have been helping startups and businesses for many, many years. And he will provide a comprehensive overview on real-life applications of tokenization and digital assets in the United States. So Adam, please take the floor.
Thank you. It's good to see everybody here. And as Anastasia said, I work at Entoro, broker-dealer, where I guess you could say the resident crypto and blockchain expert. And we work with many companies that are looking to digitize assets. And so over the years, there's just been so many different use cases that I've seen and been personally involved in. So I want to kind of walk everyone through a little bit about what different paths you can take, what to consider, and how to kind of navigate this space. So wanted to start with some basic terminologies just to make sure that we all understand what we're referring to throughout this. So we're all here to learn and discuss blockchain technology. Obviously, the blockchain technology that we're talking about is simply a distributed database that reaches consensus, right, on the transactions that occur between the participants in that network. And depending on the use case, that can actually be a public blockchain, it can be a private blockchain. BTC, we're referring to Bitcoin, the cryptocurrency that everyone knows and has been around the longest. And then ETH, if you hear me talk about ETH, I'm talking about the protocol layer cryptocurrency that drives the Ethereum blockchain. A smart contract being a codified representation of business logic in order to allow participants that are transacting to be able to do so with a predefined set of rules. When we talk about assets that are fungible, we mean that they are like money, like it's like a dollar. Just as a dollar can be exchanged for another dollar, can be exchanged for 4 quarters. We are talking about assets that can be interchanged with like kinds. And then when I talk about an ATS, what I'm describing in the US under our regulatory framework here, referring to an alternative trading system. And I think globally, people are referring to ATSs as ATSs, even outside of the United States, even though that terminology may not be used everywhere, but it's generally being referred to exchanges or marketplaces that accommodate securities. And those can be digital securities, they can be traditional securities, but if they're in a order book system where there's automated matchmaking, then typically referred to as an ATS. So, go to the next slide. So when we talk about digital assets, it's important to understand that there's different kinds of digital assets. And the first digital asset that I think most people think of is cryptocurrency, which would be any digital asset like Bitcoin. And so Bitcoin is a means of exchange, it's a store of value, it's a unit of account. And cryptocurrency is typically used as currency or as a store of value, like I think we can say, we can all agree that Bitcoin is. When we talk about a protocol token is also a cryptocurrency, but it's a little different because in the case of the Ethereum blockchain, ETH, the protocol layer token that runs Ethereum, even though it is a cryptocurrency, it's a protocol token too, because it's fungible and it serves an economic good or service, meaning that on Ethereum, if I'm going to use Ethereum as the global decentralized computer that it was intended to be, then I need to spend my ETH in order to use it. So it can be transacted like currency, but its original intention and main purpose is to act as the gas to use the features that it offers. Stablecoins are also crypto assets. They're digital assets, but they're typically pegged to some other asset. And I think the most common thing we see is that they may be pegged to the US dollar. They could be pegged to gold. They could be pegged even to a basket of currencies, but they are generally stabilized in value, proportional to what they're pegged to. And those stable coins can actually be centralized or decentralized. In the case of something like DAI, which is on the Ethereum blockchain, it's a decentralized stablecoin, meaning that it uses a complex system of smart contracts in order to maintain its value. In a centralized system, there's literally dollars in a bank account that are accounted for, and the stablecoin is minted one-to-one, and it's managed by a company. Utility tokens are tokens that are created on top of another blockchain. So most commonly, we see ERC20 tokens on top of the Ethereum blockchain. And a utility token's usefulness is that it can activate features that for which it was designed to be used within an application or a decentralized application. And they typically help drive, they use incentives within the system in order to get people to use them. Just, I guess, a common way to think about them is in the same way that you would have a ticket in order to access an event, or a token in order to use a machine. So utility tokens are another type of digital asset. And then the last type that I want to talk about today are security tokens. And security tokens, it represent an investment contract for legal ownership. And we'll take a deeper dive into security tokens because they can actually look many different ways. So we'll then go to the next slide. So what can we tokenize? What different types of assets can be on a blockchain? In thinking about creating tokens that are securities, I think this offers a lot of advantages because we can securitize almost any asset and put it inside of a vehicle where we can divide the interest, the ownership in that asset. By tokenizing securities, what we can actually do is eliminate a lot of scams because of the legal ramifications that are tied to the creation of securities. And I think that too often people associate this cutting edge technology using blockchain with being a territory where they're unsure and they feel like they may not be being told the whole truth. But whenever you have an asset that's linked directly to a contractual obligation, I think it does eliminate scams. It does create a little more certainty in terms of the asset that you're dealing with. Also creating things like dividend payouts are possible with securities. So in the way that stocks can pay dividends, you can do the same thing with creating securities on a blockchain. They're diverse. You can have access to multiple asset classes, and the way that those can be structured is really unlimited. So in talking about multiple asset classes, obviously commodities are an area where there's many different types of commodities. So we can securitize real estate, but then we can also just commoditize. We can also just create a token that represents an asset, for example, a house. And it may not be securitized, but we can have a token that represents a commodity, much like how a token can represent an ounce of gold. So if I mint tokens and store gold in a vault and represent my gold in the vault with 1 token per ounce in the vault, that's a commodity token. So we didn't securitize the gold, we're just representing what's in the vault with the asset on the blockchain, so that the owner of the token on the blockchain is the beneficial owner of the ounce of gold that's in the vault. So we can tokenize commodities as well. Linked to the securities, we can tokenize royalties and cash flows. So much like how, like I mentioned earlier, stocks can pay dividends. A company can pay a percentage of its revenue to the holders of its royalty or cash flow token. And we can actually tokenize funds as well. So when a hedge fund or a private equity fund or a VC when it raises capital from limited partners, then we can actually tokenize their interest in the fund, and their payouts, however that may be, it can actually be paid to them directly over the blockchain. And I think it was 2017 or so that a VC tokenized their LP interest in an evergreen VC fund, and it's still alive today. So it gives investors liquidity in an asset, liquidity in a vehicle that typically has no liquidity, and is you're really kind of locked into that investment for many years. We touched on utility tokens, but tokenizing utility, I think, is a very useful way to use blockchain technology, just because it's really the basis for everything that happens on Ethereum. It's the basis for everything that happens on any blockchain that uses smart contracts. Tokenizing liquidity. So with the kind of 2020 boom in the DeFi market, we are seeing a lot of projects that are tokenizing liquidity. So anytime you're tokenizing anything, you're really incentivizing the holders or users of it to interact with a network or a community in order to provide a contribution or a good or a service. And so tokenizing liquidity brings participants into a network to provide liquidity to asset pools, and so we can actually get really creative and tokenize things that I think even a few years ago we never really thought about tokenizing that much. And then tokenizing things like art, so collectibles. So we can actually, in the case of the creator or the owner of something of collectible value, we can tokenize the representation of the ownership, and then buy and sell that asset without actually having to possess the asset in our hands or move that asset around. So in much the same way, I can live in the US, but I can own real estate in Europe, and I can sell that piece of real estate to someone else. I don't need that piece of real estate here at home with me. I don't actually need to go touch it, but I can still own it. So NFTs are much like that as well. So why are we looking at tokenizing everything today? The main reason is because of, I think, the desire to innovate in order to realize what was really intended to happen all along. The creation of the Jobs Act was all about giving retail investors greater access to opportunities. And I think that the technology and the desire to, I guess, kind of play on, to have all participants playing on a level playing field is more and more important. And I think technology decreases the friction in order to give participants that ability. So, I find it interesting that if we look at the progress that's been made over the last decade, and especially with the utilization of blockchain technology, we really are seeing how the investors, the retail investors today, are really influencing institutions. Whereas I think before blockchain technology, institutions only influenced the way that everyone else invested, but because of the creation of Bitcoin, tokens on blockchains, DeFi markets, we're seeing the retail investor say, no, it's going to happen this way. And now the banks and institutions are really having to look out at this ecosystem and say, okay, yeah, we'll adapt and we'll change the way we've been doing things. And so the reason we're using blockchain is because of, I have a long list here, but I'll just hit on a couple of them. Transparency and standardization, I think, are really, really important. It kind of, again, allows everyone to play on the same playing field, where we all communicate in the same way, understand everything in the same capacity, and agree to play by the same rules. And the de-risking of the assets, I think, is really important. It's a feature that I think that is using this technology, we can all agree that the rules are the same, and so therefore there's less risk, and so we're not having to rely solely on someone's word and a piece of paper that we signed. There's actually codified rules built into the system. So if you want to tokenize an asset, and we can just use the equity in your own company, for example. There's a lot of steps to it, but I'll break it down simply. Just like any cap raise, you have to be prepared to go raise capital. So if you're tokenizing an asset, you're doing that in order to monetize it in some way. So prepping in a very traditional way is kind of par for the course. But then understanding your additional expectations for compliance and tax structuring, especially across many jurisdictions, is going to be it's going to be imperative that you have good counsel in order to understand how to raise capital from different jurisdictions. And in the US, under our regulatory guidance, we have a few different options to raise capital with exemptions. So that might be Reg D and Reg S in order to raise domestically and internationally from accredited investors, or we can go the route of Reg CF and Reg A Plus, which requires the SEC to essentially issue a no action letter stating that, which gives you the ability to go raise the capital from retail investors. So under Reg D and Reg S, it's kind of just a form filing that you do. Reg CF and Reg A, there's a lot more scrutiny that you have to go through, but it allows you to go raise from anyone and everyone. So under Reg CF, I believe in about a week, we're seeing the cap raise increase from 1.07 million up to 5 million. And we're seeing Reg A Plus increase from 50 million to 75 million that could be raised from retail investors. And in tokenizing this equity or debt, you have to decide who is actually going to tokenize it. Because if I personally don't have the skills to create a token on a blockchain and govern it, then I might need an end-to-end platform provider that can facilitate that for me and provide me with an interface to interact with the securities that I've created and issued to my investors and shareholders. And I might even decide to do that on a public blockchain, a private blockchain, and deciding which route to take is, I think, largely determined by your own ability to work with the technology, but also by where you plan for that asset to be in the future. Do you plan for it to be traded on an ATS? Do you have sophisticated enough investors that they can custody the asset themselves, or do they need to interact with a custodian? And what technologies do those ATSs and custodians currently use? What are they comfortable with? What have they already integrated? So it's good to be in the know. So when I list below things like the transfer agent, the ATS, the custodian, it's important to know if they accommodate those that you want to work with. Do they accommodate the technology that you're interested in using? So lastly, I think the holy grail for the reason why we all want to tokenize is because we want to give the investors what they want. And in a lot of cases, when you're tokenizing assets, we're talking about assets that are typically illiquid, and making those assets more liquid is beneficial to the investor. And so choosing the right venue and choosing the right structures in order to enable that are really important. And so choosing the right ATS is important if that's the route you're going to go and you're okay with incurring the costs that may come with that. But at the same time, a broker dealer like Entoro, where I work, can post shares of a company onto its site as like a bulletin board, and people can buy and sell it. It doesn't have to, your shares do not have to be in a automated matchmaking order book in order to have liquidity, because a broker dealer facilitates securities every day in a non-automated matchmaking system. To give an asset liquidity on an ATS involving market makers, I believe, is an important thing to do. And also considering how you structure your tokenization is important, using things like a 2-token waterfall, where you can create arbitrageable assets. And this is important because traders and speculators are always looking for arbitrage opportunities. Giving that to them, I think, is an important thing to do if you really are serious about creating a lot of liquidity for your assets. And also multi-exchange listings. So if you're going to list at one ATS, I think that it's worth exploring the idea of listing at more than one, because that just creates more opportunities for arbitrage. So if you guys have any questions, happy to answer. Feel free to reach out to me. Anastasia, how are we on time?
Well, actually, yeah, we made it in 20 minutes. Very good. And we do have a couple of questions. Actually, in the last couple of weeks, we have received some requests, what people want to hear. And we've seen a lot of interest in the area of non-fungible tokens. So maybe if you could very briefly give us an idea of not only what they are, but actually what businesses can apply using NFTs these days. How can one maybe exchange NFTs? Do you have to get your own marketplace, or can you put them on exchange? So maybe some insights from you on that topic, please.
Yeah. So what can you turn into an NFT? You can turn, I think, along the lines of collectibles, I think is the right terminology. So I mentioned earlier art, but you could turn any collectible asset, an asset that it itself has a value that is unique to itself, and where that one object is not like any other object in the world, and it has a particular value because of its uniqueness. And so turning that, or at least representing its ownership as a non-fungible token on a blockchain, is something that anyone can do, but choosing what asset to do it with, I think, I see people turning tweets into NFTs, and in some ways, I think it makes sense if that tweet has if it's tokenized by the person that tweeted it, and if it is relevant and has significance. But tokenizing any tweet, I think, is I don't know, it's pointless most of the time. So if you have an asset that's tokenized and is an NFT, you can sell it. So you can go to places like mintable.app to actually mint NFTs. You can define what the royalty should be paid, what percentage of its transacted value should be paid as a royalty to the creator of the NFT. You can buy and sell them in marketplaces like OpenSea, Rarible, Engine Marketplace. And in terms of how a company might think about NFTs, I think that if you're in the business of collectibles, or you're in the business of unique assets, then you should definitely be exploring it. If you're a business that maybe has art on its walls inside of its office, then you could consider turning some of that art into NFTs. Know that you're divesting your interest in the ownership of that art if you sell that NFT. But I think the average company, it may not make a lot of sense, but I think we can get creative. We can experiment and play around with it.
Okay. Great, thank you so much. And I see some messages from our guests. They also want to thank you. Merrick says that it was a great introduction of crypto ecosystem. Thank you so much.